Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about fees, costs, advice. How do you get advice? What are the costs of the advice that you get? And if there's an area that is really misunderstood, it's this area. So we're going to try to provide some clarity on the topic. So this will be an introductory video, and we'll be posting content in the future to add to a playlist that you can take a look at. Now, if you don't want to miss any of our content, make sure you hit the subscribe button and notification bell. We're posting content all the time. We draw on our over 30 years of experience helping clients prepare and transition successfully into retirement. Now, before I get too far into this video, I don't want to waste your time. If you are very self-directed in nature, if you do your own investment planning, your own financial planning, and that's your orientation, then don't watch this video. It's going to be a complete waste of time for you. So this video is really for people who are actually hiring advice givers, have a professional relationship, at some level value financial coaching and investment coaching, and are working with someone. But in those circumstances, it's really important you understand some of the implicit biases that person might come to the table with, and also how they're compensated. So we're going to talk about that, and then we're going to talk about what we think would be the best client interest model for compensation and services that are provided in this very important area. So let's take a look at that. Now, to get our head wrapped around this topic, I think it's important we talk a little bit about the various advice providers that are available to us. And you can get good advice from each of these financial institutions or providers, absolutely. So I'm not saying that they don't give good advice, but you need to understand a little bit about where they're coming from. So let's use a few examples. So the robot here stands for robo-advisors. That's an area of the financial industry that's really grown quite a bit. And it's the marriage of technology and advice, and using algorithms to provide the advice. And then there is different levels of contact through communications, whether it's video conferencing or phone, that kind of thing. And this is an emerging area, and I think will continue to be a very important area in the financial landscape in terms of giving advice. And they have different models for how they charge for their advice giving. But the most important thing is that they're out there trying to marry low-cost investment solutions with some fee-for-service advice planning. You've got the full-service brokers. Typically, they lead with investment planning, but they do wealth planning, and so that's an area where you can get advice. The life and health insurance industry gives advice as well. They tend to be more focused on how do we cross-sell clients to insurance products that the insurance companies are manufacturing, but embedded in the selling of insurance products would be some level of advice. You've got the credit unions out there that historically have been really involved in promoting thrift and savings and lending programs through mortgages or lines of credit. They're now beginning to drift into the advice giving business as well. And then you've got the banks who are involved in everything. You can't think of a single financial transaction that banks typically wouldn't be involved in. And they too are getting better and better at providing advice around retirement planning and investment planning and estate planning, and trying to marry those discussions with the cross-selling of their products and services. And then you've got discount brokerage firms. In Canada, there's Q-Trade, and then you've got all the major banks have discount trading platforms. There, you're not really looking to those platforms to give you advice, but they're getting pretty good at providing libraries of information and resource materials, typically directed to the do-it-yourselfer kind of individual. Okay, so the various providers. I have Asante in the middle because our DNA really is advice giving. We lead with advice giving, and our whole process is around first clarifying what the goals and objectives of the clients are, and even our compensation model, our preferred compensation model for clients, biased towards what's called the client fiduciary duty or best interest model, and we'll talk about that in a little bit of detail as we go through this video. Okay, let's leave this category. So to lean into the topic, I'll just ask you a question. So the question is, if you value coaching advice, do you know how you are paying for that advice? So if you're completely clear, awesome. If you're not clear, then we're going to hopefully give you some information that'll help shed some light on this important topic. Now, to be clear on this topic, one of the things that creates a lot of confusion is the financial services industry and advice giving industry will often combine or marry the cost of an investment or securities to put in a portfolio, as an example, with advice and service. So they've created these investment strategies and products and services where they marry the two things together. And the unfortunate thing about that is it really muddles the discussion, because when you begin combining the service and advice side with the security side, you begin to create a lack of clarity. There needs to be, in our view, a clear separation between those two worlds. So let me give you a few examples of what I'm talking about. Now, the first example is something as simple as a guaranteed investment certificate, or a GIC, or a term deposit you might get at your credit union, your bank, your trust company, even your insurance company. And a lot of times people, they say comments like, well, there's no cost for dealing with a financial institution when they're buying GICs. But there is a cost. Sometimes it could be an opportunity cost, because maybe the GIC returns that you're receiving are not competitive and may not be the best investment option for you. And the other cost is you are basically extending a loan to the financial institution, and then they're using your money to make money. So always the question is, why don't you do that? Like, why don't you do some of the same things that the institution's doing? But at a very basic level, if you buy a GIC, and let's say they're going to pay you 2% a year for the life of the contract, you know, at least you should know at some level, they're going to take that capital, let's say it's $10,000, and they're going to loan it out, they're going to reinvest it. Let's say they put it in a mortgage or a line of credit, and they could get 4% on that loan. So they're making money on your money, so that's a 2% spread. Most institutions do have an arm, a very large arm of their business, which is spread business, the difference between what they pay you for you giving them a loan, essentially, and then they'll take that money and reinvest it and make money on your money. So it's not free. They're leveraging, they're giving you an interest rate, but they're doing things where they think they can get a much better return than what they're paying you. Okay, so that's one example. So most investors don't see GICs or term deposits as having embedded costs, but I would view this as an embedded cost. And you don't really have great transparency overall as to what the overall return is on those institutions. They're going to take your money, and there can be a wide range of products and services that money might find its way into. It could be, Visa cards, it could be lines of credit and mortgages and that kind of thing. Now, I get it. At the end of the day, the only thing you're concerned about is that 2%, and it's guaranteed for 5 years, and you get your money back at the end of that term. But there are embedded costs, and that's the spread business that I just talked about. Now, by far and away, the most common example of embedded costs that many Canadian investors have experienced is with mutual funds. So mutual funds will typically have three major cost structures, often referred to as the MER, or management expense ratio. So that ratio is a combination of these three costs. So the first cost here in red, I'll just call it expenses. I'm saying it's a 1/4 point a year, so 0.25. And what are expenses for an investment product? Typically it's prospectus filing costs and legal and accounting costs and safe custody costs and trading costs, all the costs it takes to run that particular investment product and service. And so there's an embedded cost that gets charged to the portfolio internally. You then have in the yellow here the PM, or portfolio manager cost, and that's basically a mutual fund manager going out and either using in-house portfolio managers or going out and headhunting for money managers that will manage money in the US or in Canada or around the world, and big cap stocks and small cap stocks in the bond market. But basically they'll pay a fee to that manager. It gets deducted from your investment trust at 1%. So these two costs, the expenses and the PM, or portfolio manager costs, are tied directly to the investment mandate of the portfolio. So you're paying a cost, you can track it back to the security. I want to have a balanced portfolio of stocks and bonds. I'm going to pay 1% a year to get that expertise. But there's a third cost, and that third cost often is what I refer to as advice and service costs. That's the cost that either goes to the branch or the credit union or the individual advisor you're working with. And that cost can vary, but in this example, I'll say it's 1%. The problem here is that there are various services being provided by the advisor or institution under advice and service that are not explicitly tied directly to the portfolio. So what you have is this merging of two things, advice and service, and then a cost attached to the portfolio manager. And it starts getting a little bit gray in terms of what you're actually paying for. So what's the advisor's role or institution's role? Well, there'll be various things they might be doing. We'll talk about that in a second, but not all of it's going to be purely related to this investment product. And this is the first problem that I want to speak to, is you're beginning to merge costs for services that are not directly tied to the investment product that you are purchasing. This is a very common model. So still extremely common. It's the most prevalent model in the industry where people are buying investments and they have embedded costs. So if I have a mutual fund, it's going to have embedded costs for the portfolio manager and expenses. If you buy an ETF, an exchange traded fund, they will have embedded costs. Now the difference with ETFs is often they will not have attached to them the advice and service cost. And I'll talk about how that works in a second. Okay, so we start with the GICs, the spread business. Now we're with mutual funds, we've got this MER. Let's go on to the next topic. Now, when we talk about embedded costs, although it's very common in the industry for this structure to be used, it does have some inherent problems. And the problems are, first of all, conflict of interest. In other words, when you're dealing with an advisor and they're getting compensated for service and advice, and also recommending that service, then it's not really an arm's length relationship. Now, when you walk into your Royal Bank, as an example, or your credit union, if they recommend to you, let's say, bank products and services, you're not surprised by that. It's like walking into a Ford dealership or a car dealership of some kind. You know they're going to recommend their cars, right? But when you talk to a broker, whether it's a stockbroker, wealth planning consultant, or independent financial advisor, you have, I think, at some level, an expectation that they're not going to be in a conflict, either a real conflict of interest or a perceived conflict of interest. And embedded compensation structures potentially put the advisor or advice giver in a bit of a conflict of interest, or at least a perception of a conflict. And it's very important that the advisor speak directly to that perceived conflict of interest when dealing with clients. The other thing is poor transparency. In other words, the client may know that they're paying for advice. So if I go back to this slide here, they know that there's a 1%, let's say, for advice and service. They've been given a prospectus that goes over that. But it's not super transparent. It may show up in a year-end statement that the dealership or the advisors associated with is providing, but it might be an overall on the whole portfolio. It's just not really super transparent. And then the last thing here, it leads to a lack of investment flexibility. And what I mean by that is you could be dealing with an advisor, and let's say all of their compensation is tied to embedded compensation like this. Now, the minute that happens, they're basically tied to only certain products and services. So if they want to be compensated, and it's through embedded compensation, they need to sell mutual funds with this advice and service, or what's called a trail fee. They need to sell insurance products that might have commissions or compensation built into them, or they might use spread business and get a finder's fee from the financial institution when they place GICs. But they are bound to certain kinds of products and services to generate revenue to be compensated. But what happens when there's an exchange traded fund that might be very appropriate for your portfolio? What happens if there's an individual stock that might be very appropriate for the portfolio? If the advisor is using embedded compensation, they may not be able to get compensated to monitor and place that business in the portfolio, that security in the portfolio, because there's no embedded compensation on things like exchange traded funds or individual stocks typically, right? So it creates this basic problem of potential conflict of interests, poor transparency on costs, and it leads to a lack of investment flexibility in certain relationships. And I would say that's probably the most prevalent situation. The advisor might rationalize and say, well, we don't need to be looking at stocks or ETFs in the portfolio. We can build a portfolio perfectly well with the options we have that provide embedded compensation. But I think in an ideal world, you want to have an advisor who has access to all kinds of securities to build a portfolio. Yes, they might have their biases, and you want to ask your advisor what their biases are, but at the end of the day, they should have that flexibility. Okay, so if there's some inherent problems with the model around embedded compensation, what's an alternative? So in our practice at Asante, we have what we refer to as fee-based accounts, but basically what these accounts do is they provide for greater cost transparency for the client. It deals with the perceived and real conflicts of interest that I just talked about. It provides administrative or investment flexibility, and it has the potential to create some fee deductibility on the portfolio as well. So let's look at a schematic that kind of reviews this in a little more detail. And the way you want to look at it is through this the lens of these two columns. Now, the column over here, what we have is a mix of investment options. So I've just listed here, you could have mutual funds, you could have ETFs, you could have stocks and bonds, GICs, and insurance. Now, at the end of the day, what you want to do is you want to separate out the service and advice costs from these investments. So you can see that I've got basically two columns, and we'll look at one column where right down the middle over here we're going to have advice, implementation, and service. You can see over here we've got strategy development, the implementation of the strategy, the monitoring of strategy, ongoing coaching for the client, education, service, and administration. Strategy really is doing the financial plan, doing the retirement plan, doing the estate planning. It's monitoring the planning. And one of the areas that the advisor will get involved in is the implementation of investment recommendations as part of the financial plan. Now, the minute that happens, as we move on to this side of the column, you would have mutual funds and ETFs, stocks and bonds, GICs, would be the most common types of investment products and services that would be utilized. But the biggest difference in this model is that over here, there are no embedded costs. So remember, we talked about the other embedded costs and the other products and services. So for instance, when we build a portfolio for a client, on the mutual fund side, we use what are called F-class mutual fund units. There's no advice or service costs embedded in those programs. So again, if I go back up to my schematic here in the mutual fund, this category here called advice and service on an F-class investment doesn't show up. So it's completely moved out of this investment structure, and the only costs that show up are the pure investment costs for the portfolio manager and the expenses attached to the program. Now, ETFs are the same thing. So if you look at most fact sheets for an ETF, the ETF is going to have a management fee or a management expense ratio. It might be very, very small. Might be 7 or 8 basis points upwards to, it could be close to 1% depending on the portfolio. But again, with the ETF, there's no advisor compensation. You're paying purely for the security. On stocks and bonds, on stocks, as an example, you typically would have a trading cost. On our platform, it's a very small cost to buy or sell stocks, and typically in our portfolios, we actually look after that cost for clients so they don't have a concern about churning or conflicts of interest on why the trade recommendations came to them. But there's no embedded compensation to the advisor or to our practice when we make stock recommendations, as an example. Now, GICs, typically GICs and savings accounts are what we refer to as non-billable assets. That's spread business. We typically try to just find the best yield for client if it makes sense for them to have a GIC, and it's not a billable asset under our fee-based program. Okay, so at the end of the day, it's going to be your mix of investments here that will ultimately determine what you're going to pay for the investment side of the portfolio. And there should be no compensation coming back to the advisor over here from the portfolio. That's a separate discussion. We'll talk about that in a second. Okay, so point number one on this platform, cost of investments are purely a function of the kinds of investments that are in the portfolio. You could drill down to low-cost ETFs and individual stocks. That would be the lowest cost, potentially portfolio mix on the security side. Is that the best mix? Quite probably not. And that will be another part of a video series on this topic. But at the end of the day, as an advisor, I don't have any skin in the game in the sense that if I had a really cost-sensitive client on the security side, I'll talk about my concerns if I don't think it's an appropriate strategy. But at the end of the day, it doesn't change our compensation model in terms of the advice and services that we're providing for the client. Okay? So securities, they have their own costs, and the mix of those securities are what determines the overall cost on the portfolio. Now, what about the cost of advice? Now, advice costing, what's the client paying for? The planning, the strategy. Some of that planning and strategy may not be a function of specific investments. It could be tied to a retirement plan. It could be tied to an estate plan. Implementation assistance, so helping the client build a portfolio, getting the investments for them, providing statements, monitoring. coaching when needed, and education, and then service and administration. So I know with our practice, we've got a 3-person team just for our own client mix and client base, just to deal with service and administration on the investment side and on the retirement income planning side. And then there will be a cost borne by the client for that service. And at the end of the day, what we typically see is that clients, when they look at this model, usually are paying less in total costs compared to the embedded compensation structure. There's far more transparency, and they know that we don't have any skin in the game as it relates to the specific products and services. Yes, I have some biases. I'll share those biases and why I think it makes sense to have those biases for portfolio designs. But at the end of the day, the client goes, well, you're not getting any direct compensation, so I know that you're going to be a little more objective in terms of the kind of recommendations you're going to give to us. So that really summarizes the first video on this topic. Again, let's just kind of go over the main points. The problem with embedded compensation, which is the majority of the way compensation is charged in the industry, is it's not super transparent. There's potential conflicts of interest or real conflicts of interest, sometimes a lack of investment flexibility and choice. And so that model, in our opinion, is not the ideal model. So the ideal model is to separate the investment portfolio that's been recommended from any costs and for the services that the advisor or consultant is receiving. So the model we use is that one. We want to create a clear separation so that there's greater transparency of costs. It deals with the conflicts of interest. There's administrative flexibility and choice in terms of investment options and potentially fee deductibility on the portfolio. Now stay tuned. Make sure you hit the subscribe button if you're not already subscribed and the alert bell, because we'll be coming up with other videos that complement this first video on this topic. So make sure you do that. As well, in the show notes for this video, you can find links back to our website, a link back to our retirement coaching page. There's some great resources there you can take advantage of as well. And then, of course, we've got some other resources on our YouTube channel. Feel free to poke around and take a look at those, in addition to the content that I've just gone over here today. Anyway, wishing you all the best in both your retirement income planning, investment planning, and wealth planning journey. You take care. Bye-bye.